Ruger and Smith & Wesson Holding Company by Matt Gray and Jordan Cast for the Honorable Judge Shiroki. These two companies are firearm manufacturers based in America. And who are the shareholders of these companies? Smith & Wesson has a institutional mutual fund ownership of about 65%. 2% is held by insiders and 5% owners. And there are about 169 institutional holders of Smith & Wesson stock. Here is a chart of the top institutional holders. I'll go ahead and let you take a look at that yourself. The breakdown for Ruger, 3% are insiders and majority owners. 86 are held by institutional investors, and there are 176 institutions invested in Ruger. You can see that a lot more of the stock of Ruger is held by institutions, and it may prove that Ruger is more attractive to professional investors than Smith & Wesson. Here's the breakdown of Ruger, majority of the institutional holders. So why do investors care about capital structure? Well, investors obviously care because how a company structures its capital ultimately leads to costs to run operations. If costs can be minimized, profits will be maximized, and shareholders will benefit. The advantages of debt are that lenders of money don't get to tell businesses how to spend the money they lent. This allows for a lot of freedom for the business to spend the funds however they see fit, and it's having one less person look over your shoulder. The interest on loans is always going to be tax deductible. That actually makes the cost of borrowing a little bit cheaper. And finally, loans have predictable cash flows going in and out of the business. You know you're going to have to make your interest payments, your principal payments, and when you're trying to forecast your costs, it's a lot easier to know that you have scheduled payments than not. The disadvantages of debt. Debt's often seen as risky because it could kind of bury a company that can't keep up with the payments. If a company goes through a tough stretch where they're not collecting receivables, or they're less sales than they normally have, they might fall behind on these debt payments, and it's never good. Their credit rating goes down, things get more expensive, and they could eventually take the business down with it. Interest payments also take up a lot of the positive cash flow that could have been used for the company in other ways and towards more beneficial endeavors, projects, things like that. The advantages of equity is pretty obvious. In the short run, equity doesn't even have to pay anything to those who have given money in terms of equity. Equity financing allows more funds to go back into the business because interest and principal payments aren't being made. They just are essentially given the money. Now, the disadvantage of equity is that when they're given the money, they give the investor a share of the company. And so the owners lose some say in what the company is going to be doing and how the company is run. So on that side, whoever owns the company before they do an offering, they'll have less say in how the company is run. What is the cost of debt? Well, for Ruger, Ruger's got an interesting situation because they have zero debt. No long-term debt, no bond issuances, no operating leases, they don't rent their space, they own everything. The only debt they have are pension fund obligations and accounts payable. So we're able to determine that by looking at the interest coverage ratio of Ruger, that they have a AAA rating, as their interest coverage ratio is nearly 600. The only bond issuance by Smith & Wesson is a 9.5% coupon. The bonds were issued in the beginning of 2011 and are the only long-term debt held by the company. Their after-tax cost of debt is just over 6%. What is the cost of equity? Maybe Shiroki there would be able to help you out. Here, we're going to give a little background information before we go into the actual cost of equity for each company. We ran regressions against the S&P. Here's Ruger versus the S&P over 5 years. using monthly price points. The beta came to be 0.23, and correlation is obviously very low between the market and Ruger here. Here, Ruger is being compared with the S&P 2-year weekly price points. Beta shows to be 0.19, and there's a slightly higher correlation, but still pretty low. Smith & Wesson versus S&P over a 5-year period, monthly price points. Beta shows to be 1.37, and there's a much higher correlation here than with either of the Ruger regressions. And finally, here we have the Smith & Wesson versus the S&P over 2 years with the weekly price points. Beta looks to be 1.47, and this is the highest correlation of all regressions we ran, so it looks to be pretty correlated with the market here. So, as we said, the correlation between the market and Smith & Wesson are much higher than that of Ruger, but Smith & Wesson's beta is also significantly higher than Ruger's. In both cases of Ruger and Smith & Wesson, there are pretty serious discrepancies between the beta calculations from major institutions and what we found, but our beta calculation aligned with NASDAQ for Ruger, but was much closer to the Yahoo Finance estimates for Smith & Wesson. Overall, the cost of equity for Ruger is 3.045%, the same as their cost of, that's their cost of equity, and Smith & Wesson's is 8.545%. So, what is the overall cost of capital? For Ruger, it simply matches their weighted average cost of capital at 3.45%, and because they have no debt, no preferred stocks, their debt ratio is 0, preferred stock ratio is 0, equity ratio is 1, it comes out pretty simple. Smith & Wesson has no preferred stock, but they do have some debt, just under 10%, as you can see by the debt ratio, and that leaves a little bit over 90% in equity. Their WACC comes out to be 13.63%. How would a change in the capital structure affect the company? In Ruger's case, well, here's the summary of inputs. So I'll go ahead and let you take a look at that. And then here's the results from the analysis on the spreadsheet. It says Ruger's optimal debt-to-equity ratio would be about 20%. But as we can see in the next slide, I'm not sure that's exactly true, because here, if they had 20% debt ratio, they would have a higher valued company, but the bond rating would drop, and that's not exactly ideal. I think a more ideal situation would be to have it between 10 and 15%. That way they'd be able to maintain their bond rating, in addition to increasing the value of the company. Smith & Wesson, here are the summary of inputs and the results from the analysis. They have a current debt-to-equity ratio of 9.77%. It says the optimal ratio would be 0%. It would lower the beta, lower the cost of equity, and slightly increase the overall cost of capital while devaluing the firm, which is curious that they want there to be 0, the debt ratio to be 0. As here you can see that in terms of what I've seen, it looks like they're pretty close to the optimal point here. 10% helps them increase or have a higher valued firm, in addition to keeping their AAA bond rating. So I think they're actually in a pretty good position where they're at right now. So does more debt equal more risk? Who's better? Well, Ruger would be valued the highest at 40% debt, but the bond rating again would drop to an A-, and that wouldn't be ideal. So Ruger would probably be able to take about 10% of debt without hurting his bond rating, and the value would slightly increase. But Ruger's a really unique situation because they don't have any debt, they don't seem to want to have any debt, and they kind of take pride in that, being able to say that. Smith & Wesson carries just under 10% of debt and is actually close to the ideal debt ratio in my eyes. The optimal debt ratio is said to be 0%, but that would drop the value of the firm by $25 million. With 10% debt, the company maintains its AAA rating and its higher value. Corporate restructuring. Again, we're going through this. A lot of this was answered in numbers 6 and 7. It can be seen that Ruger could add value to the company by having 40% debt, but they don't want to do that because it would decrease their bond rating. Smith & Wesson, they're at 9.77% debt ratio. They probably could go up to about 15% and still be alright, possibly increase the value, but I think they're in a pretty good spot where they are, and there's no real need to increase the debt ratio. What are other companies doing? Well, compared to the industry, here here's a little chart. Private 1 and Private 2 are Browning Arms and Remington. They're Smith & Wesson and Ruger are the only two publicly traded firearm manufacturers, so we have to compare them to the industry, and a lot, we're comparing them to one another. So it can be seen here that Ruger is a much larger company than Smith & Wesson, but only marginally outpaces the industry average in size. Ruger is just over $1 billion in value, while Smith & Wesson's about just over $600 million, and the industry average is about $950 million. The most significant difference between Ruger and the industry is earnings per share. Ruger has a high EPS at $3.12 compared to the industry average of $1.34. And then both the industry and Ruger proved better than Smith & Wesson in terms of earnings per share, when Smith & Wesson only has 82 cents per share. Again, Smith & Wesson is a little more than half the size of Ruger and is about 2/3 the size of the industry average. The company's quarterly revenue growth was pretty similar to Ruger at 0.48% and 0.47% respectively. Both outpaced the industry average of 0.19%. Now, are these companies fairly priced on the stock market? Well, with Ruger doesn't have any debt, so we use the APV approach to determine the value of the company. The company is to be worth it's said to be 50% more valuable than shown in the stock market. I don't think the market fairly priced the stock because the low cost of capital makes future projects much more profitable. You can have fairly liberal expectations about future margins, and so in the middle of March of 2012, the cost of the stock was $49.10, but the market caught on, and by the beginning of May, the stock had actually risen to $57, which created, or not created, but it got the stock closer to the actual unlevered value of $1.5 billion of what we calculated compared to the just over $1 billion that the market had the company priced at. So to do Smith & Wesson, it was interesting. There are no dividends, so we can't really comfortably project if there's going to be cash flows coming to investors in any way. So we decided to use Ben Graham's old formula that he used to use to show intrinsic value of the stock. So here the formula is V equals earnings per share times 8.5 plus 2 times growth. So V is just the intrinsic value, and when you plug it in, we get $7.82 should be the value of Smith & Wesson stock. At the time at October 31st, 2012, the stock was priced at $9.59, which would show the stock would be overvalued. Firearm companies tend to have slow growth because they aren't out marketing their products like car or food companies. They just kind of they sell good products and just rely on company or customer loyalty and things like that. So they're not going to have huge growth in that aspect. The one thing that caught my eye was that Smith & Wesson's only trading at a multiple of 11 compared to the industry average of 16. So basically, this company's on sale. Now, is there a reason for it? It's likely so, but it's still cheap relatively compared to the industry. Both of these companies are inherently conservative, and it shows in their capital structure. Ruger has no debt at all and plays pretty conservatively. They're both firearm companies. They're going to be conservative by nature. They'd rather have no debt and a high bond rating than bring on the risk of debt to increase the value of the firm. And Smith & Wesson is a little more adventurous. They've taken on a little bit of debt, but still having a 9.77% debt ratio is still pretty conservative, if you ask me. Ruger, say it's an undervalued company because average cost of capital is so low. Future projects could be so profitable. There's potential for solid margins there. So I think that it's a little bit underpriced. So I think it was an apparent when the stock moved from 49 to 57 within 6 weeks after the prices that we did this report on. It's pretty. It hasn't stayed at that level, but it was underpriced for a little bit. Another thing that makes Ruger valuable is it gives a 3% dividend with not exciting growth prospects, but they look like they're going to have positive cash flows for a long time, and they're going to be able to generate profits. Smith & Wesson's a little more risky because of debt, but also has a shockingly high cost of capital. It's difficult for this company to take on any projects because the returns have to be 14% just to be considered. The average cost of capital is way too high for them to really be focused on growing. So our analysis showed that Smith & Wesson is overvalued in the market, but I think it's priced pretty fairly. It's on sale. Like I said, it's trading at a multiple of 11 compared to the industry average of 16. The main reason this stock isn't going to be going anywhere is because the cost of capital is holding them back.